Yo, my name is Sebastian. So in my video last week, I introduced the stock market. But stocks are not the only assets or the only securities that you could trade in the stock market. So you could also invest your money in bonds, mutual funds, index funds, ETFs, and plenty of other things. But the four that I just mentioned are what we're going to talk about in this video. So just like last week, we'll keep it pretty simple and stick to the basics. A company that runs out of money and that wants to keep growing will have to raise the money from somewhere else. Now, if they don't want to sell part of the company, one way they could do that is by creating bonds and using them to borrow money from investors. Now, let me give you an example to show you how that works. Now, say I'm the company that needs to raise $10,000 and you're the investor with some money available to invest. So what I'll do is I'll create 10 pieces of paper and I'll call them bonds, and I'll give them each a value of $1,000. And then I'll come to you and I'll tell you, for each $1,000 that you lend me, I promise to pay you 5% interest annually. And then after 3 years, I'll give you back the full $1,000. Say you accept and you decide to lend me $5,000. Now, since each bond is worth $1,000, then I'll give you 5 of them. And since I'm paying you 5% interest annually, so in year 1, 2, and 3, I'm gonna pay you $250. And at the 3-year mark, at that due date, you bring me back the bonds and I give you back your full $5,000. Now, since I originally needed $10,000, I just had to find a different investor and do the same thing and raise that other $5,000. Now, in our example, that piece of paper, that bond, is kind of like a promissory note. So it's kind of like a legal document that contains all the information about the loan. So bonds are usually considered less risky, especially if they're from government agencies. Now, the problem with them is they usually don't pay much. So the safer it is, the less interest you get paid. And that's why it's not usually recommended to have a big portion of your portfolio invested in bonds, especially if you're young, because you have enough time in front of you to take more risk and potentially get a bigger return on your investment if you invested in something like stocks instead. Now, as you approach retirement, then you can invest in them more so you can have a more reliable and more stable stream of income when you actually do retire. Now, say that you've been investing in one company stocks for 10 years straight because it's been doing well. Now, say a different company comes along and puts you out of business, or for whatever reason, the company goes down. You've been investing your hard-earned money for so long and it could all be gone just like that. And that's the problem with putting all your eggs in one basket. And that's where mutual funds and ETFs can help address that issue. They're essentially a basket or a collection that contains one or multiple types of different securities like stocks, bonds, commodities, etc. So that collection or portfolio can hold securities from one particular sector, like healthcare, for example, or it could be a mixture of different sectors in the market. So instead of buying one share of one company, you'll be buying a piece of hundreds and sometimes thousands of different companies. Let's first take a look at mutual funds. So there's 2 types of mutual funds. So actively managed funds, also just called mutual funds, or passively managed funds, also called index funds. Now, like the name suggests, actively managed funds are actively managed by one or multiple people, and they make changes to the portfolio regularly in the hopes of having a better return than the market. Now, these financial managers, they buy and sell stocks, bonds, or whatever else in the portfolio based on what they feel will make the investors more money. Index funds, on the other hand, trying to mimic a particular stock market index. Now, a stock market index is a tool used by financial institutions or investors to measure how a particular sector of the market is doing. So it's kind of like an average that gives you a good idea of which way that sector is going. For example, say that you wanted to know how the stock market in the US was doing. The S&P 500 would be a good representation of that. So that index is calculated for using the price of the stocks of the 500 biggest companies in the US. The MSCI World is an index composed of 1,655 different companies from all over the world and represents the global market. The NASDAQ composite is composed of 3,000 stocks from mostly tech companies and is a good representation of the tech industry. There are all sorts of indexes or indices. I'll just use indexes. So there are all sorts of indexes for all sorts of different things. So not just stocks, but you can't invest in them because they're just numbers. Now, index funds, however, they try to replicate them by putting the same companies that are in those indexes in the funds. Now, those funds are what you could invest in. For example, there's an index fund called the Vanguard 500 Index Fund Investor Shares that has the same stock as the companies in the S&P 500 and try to mimic its results. The S&P GSCI Commodity Fund track things like oil, precious metal, agricultural goods. If you want a snapshot of the real estate market, you can look at the Dow Jones Real Estate Index and invest in an index fund that mimics that index. So whatever sector you're interested in, there's probably an index fund for you. Mutual funds or index funds, they don't trade on an exchange like stocks or bonds. So you can only buy or sell them once per day from companies or brokerages that offers them after the market have closed. That's where ETFs or exchange traded funds comes in. Now they're similar to index funds in that they're a collection of different securities and that they typically follow an index. But the biggest difference is they trade like stocks or bonds. So you could go on a stock exchange and sell or buy them anytime you want. So let's say you didn't want to invest in bonds because the returns were too small, or you didn't want to invest in individual stocks for fear of losing all your money. So mutual funds and ETFs are definitely a great option. So they're more risky, but there's more upside for growth and they're well diversified, meaning that your investments are spread across different companies and different sectors. So if one of the companies fail, then that won't affect you too much. But which one would you choose, ETFs or mutual funds? So there's a couple of things that you should consider before making that decision. So what are you trying to do, right? Are you investing for the long term, or are you trying to make money in a short amount of time? How much money you have available to invest? How much money these services are going to cost you? Are you trying to automate your investments? Let's first look at cost. Now, for actively managed funds, they have financial managers that are making decisions on a regular basis. So they're buying and selling common stocks within the portfolio to try to hit a certain target to make their investors money. And that's going to cost a premium. Now for index funds and ETFs, they pretty much follow an index. They don't need to be altered, so they don't change very much. So they typically cost less. Now that money that you pay annually for these services is called expense ratio. Now it could be as high as 3% for managed funds, or it could be as low as 0.04% for ETFs and index funds. Now these numbers might not sound like a lot, but if you're investing for the long term, then they could add up and take a lot of your money. And then you need to be aware of how much money you have available to invest, because some mutual funds require a minimum amount to start. So say you wanted to invest in the Vanguard 500 Index Fund Admiral shares, which is a pretty good one that mimics the S&P 500, then you would need a minimum of $3,000 to start. Now for ETFs, because they trade like stocks, you could go on a stock exchange and buy one at the price of a share that could be a couple $100s or less. The last thing I want to go over is convenience. Now, every time you want to buy or sell stocks, bonds, or ETFs, you have to pay a commission fee to your broker for processing your transaction. So say you wanted to invest $100 from your paycheck every month, then you would have to pay that commission fee every single time. Mutual funds and index funds make that process really simple. So you can link up your account with your bank and have that process automated, where it automatically grabs a specific amount from your account and invest it commission free. If you're getting dividends, you could also reinvest that and not pay any fees. See, for me, I'm trying to invest for the long term. So for the next 15 to 30 years, I'm not trying to pay any high fees, and I'm trying to automate as much as possible and not have to worry about what the market is doing in the short term. So with that said, index funds are what I'm interested in. The only way to know what's best for you is to educate yourself, do your own research, and talk to a specialist about your different options. So there you have it. That's all I got for today. If you think this video was helpful, like, comment, share, tag a friend, or subscribe to my YouTube channel. Thank you guys so much for watching, and I'll see you next week. Peace.